Hi, this is Jean Joe, broker and owner of Perisson Real Estate, and I'm back with another edition of Perisson Pulse. Today, we'll be continuing on to the second half of our session on long-term care insurance. Before I go into that, just a quick reminder for those who are watching this in real time of our seminar next Wednesday, April 17th, about mastering financial essentials in retirement. It will be at 7 p.m. at the Millbrae Rec Center, and we actually have a full room signed up already. But if you'd really like to join us, you can give me a call and we'll squeeze you in. So let's get started with the video.
So another thing about the hybrids that's different than the traditionals is they have different funding options. So one is like in real estate, you could do what's called a 1031 exchange, right, Gene? You probably know all about the 1031s. So in life insurance, they have what's called, it's basically the same thing. It's called a 1035 exchange. So you can use an old life insurance. Maybe you bought it when you first got married, and maybe it's just not, no, it's not performing that well. You can actually exchange it into a long-term care policy or life insurance policy. You have that option to exchange to something that might be better for you. The other thing is you can move money from the annuity. Maybe the annuity is not performing. You can move that into the hybrids as well. And one thing that's really unique is in this hybrid, you can actually use taxable assets, IRA, SEP IRA, or 401k funds. So for here, you have to be 59 and a half for this to work. But it allows you to buy a long-term care policy. Maybe you're closer to retirement and you never really thought about it. Now, you're maybe 6 years old. You're like, oh, maybe I need to do something, but I don't want to use up all my cash. So you can reallocate some money from your retirement to help pay for this policy. So, Jean, did you know long-term care premiums are tax deductible?
I do now.
So long-term care premiums are tax deductible. So the C corps benefit the most because they can deduct, especially in a hybrid. If they decide to buy a hybrid, they can deduct everything in 1 year. So they have the most tax advantages. If you're an S corp partnership individuals, you're able to deduct your premiums, but it's based on age tiers. So the older you are, the more you can deduct. And you can actually use your HSA account to pay for long-term care premiums as well. So the government wants you to actually have long-term care so you're not depending on them. So they incentivize you to buy your own long-term care policy. Okay, next. So I want to talk about Washington State's mandatory long-term care insurance. And the reason I want to talk about the Washington's program is because it's fully in place right now. And if you didn't know, 13 states are working on the mandatory long-term care insurance for everyone in the state. And so California has been working on this for about 2 to 2.5 years. So right now they are in the process. They have 5 plans from bare to kind of luxury long-term care. So it's in the legislature right now. But Washington is already established. I want to use this as an example to explain how California's could potentially look like this. And so with Washington, basically, they give you, remember we talked about the bucket of money. So they give you here 36,500 of lifetime long-term care benefits. To qualify, remember at the beginning, I said, well, to qualify for long-term care in general, it's usually 2 out of 6. Washington makes it a little bit tougher. You can't do 3 out of 6 activities of daily living. Their deductible is 45 days. So basically you have to pay out of pocket 1 through 44. And they actually pay for home or facility based. So basically, whether at home, senior care facility, or nursing home. So the eligibility and enrollment, basically how it's going to go is, or how it goes right now is you start paying as a W-2 employee when you start working from the get-go. And it's going to take you 10 years of paying premiums to get this 36,500. So it's a 10-year vesting period. If you're close to retirement, it'll just be 3 of the last 5. And so in Washington, there is no contribution cap, meaning the more money you make, the more you pay, because there's no cap. There's no employer contribution, so it's all on the employees. And how much is the tax? The tax is like 0.58% for every $100. What that means is it's about $580 for every 100,000 you make. So if you make 100,000, it's about 580. Then if you if you make 200,000, then it's 1,000, 6,000.
1160.
Yeah.
Mhm.
So that's how theirs is structured. And the opt out. So when this was launched in 2021, they told the Washington residents, okay, if you have your own private long-term care policy in place by November 2001, you can opt out of this tax. So what happened was that they told everyone probably like springtime, summer of 2021. So everyone started to try to get these policies, and they tried to get really small policies. Some people tried to get bigger policies, but the thing is, it crashed the insurance system. And so there were a number of carriers in Washington State, and they said, it's too crazy. We're just going to pause policies. So we're not going to issue. So they stopped issuing policies in October. So even though the deadline was in November, they stopped issuing in October. So all the people that were in the pipeline, they just end up paying the tax.
And then since then, there's no option to opt out.
There is no option to opt out. You can do, so in Washington State, what they do is they give you, like, if you buy something now, they'll give you prorated opt out, but you'll still have to pay some type of tax.
I see. But you can still buy your own long-term care insurance. You just can't opt out of paying for the public one.
Yeah,
completely.
the companies came back
Uh-huh.
after the deadline.
Got it.
And so now they have policies, but you can't escape the tax. So I just want to show, so I think this is kind of a good idea of, okay, what the people in Washington kind of dealt with. So this is different incomes. Okay, this is tax. And these are the benefits for Washington's program. So if you made 100,000, you'd pay 580 in tax per year. Remember, you have to pay 10 years to get this. Okay. If you made 500,000, this is your tax, and this is what you get. So the person making 100,000 versus the person making 500,000, they're getting the same, but one person is paying, almost 5 times as much tax. Okay. So what happened to those lucky people that they got in before then, and they bought their own long-term care insurance? So what happened was that if someone used that 580, they actually were able to purchase long-term care of 73,000. Wow. If that person made 500,000 and this is what they're spending yearly, they would have 350,000. So almost 10 times as much coverage, just getting your own private insurance.
And considering the cost that you mentioned at the beginning, 36,500 a year is definitely not going to cover the whole cost that is needed, right? It's only a fraction of what you need. So.
Yeah, the 36,500 is low, but remember, it's a 10-year vesting period, Jean. So if you need care in year one, you have $3,650 because you haven't vested yet.
Right, but once I'm saying, even if you vested, you've gotten to the point where it's the 36,500. That's still not enough. I mean, that's quite low compared to the whole annual cost that you were mentioning before. So
it's very low.
It's still something, right? But it's not.
And it helps out the people that are on the lower income. I mean, it's good for them. But if you are able to, if you're a higher income, then it's not as good a benefit for you.
Okay.
So here I have the California plans. And so how it goes is, so it goes from minimal to high. And in some of them, they're trying to figure out, well, what's going to work? Should it just be home care? Should it be facility? Should it be both? So they're still working on it. But as a group, we're kind of trying to say, well, we think they're going to be in the middle. And so, the taxes are here, right? The tax rate here, but here are the benefits. And so you can see here, this is lower, and then this is the highest benefit. But where do we think, as a group, what does long-term care research think we're going to be? So we kind of think it's going to be about here. So if you look at your income is up here. About this could be the tax rate that we might be looking at. And, we're looking at maybe you'll have 81,000 of coverage, around there, which is, that's not bad. But with the prices we showed earlier, that's not even going to get you a year. But it's better than nothing. I gotta say. Here, if it's 100,000, then it's 1,360, so 1,316 tax. Here, if you make 200,000, it's $2,720. If you make 300,000, it's about 4,000 in tax. And here, if you make 400,000, it's 5,400 in tax. And California is proposing a $400,000 cap on income. So this will probably be the max yearly tax if they decide to do the cap. The other thing is that they're proposing is the vesting period. So they're thinking about a 10-year vesting too. So you'll have that amount, but only after you pay for a certain amount of time.
And that's 81,000 annual benefit.
Yeah, that's where we're kind of thinking. So, ballpark, we think that's where it's going to be.
And how soon are you thinking that are we looking at a year from now or a couple years out or and I guess does this have an opt-out option? Is that what they would all do you think? Or
Oh yeah, so basically the opt-out option is you would have your own, the only option is to have your own private long-term care insurance,
Mhm.
and that will help you opt out. Some big corporations have actually sent out letters to their employees, like Costco has actually notified other employees that this potentially is coming, so they're trying to start a program. I'm not sure how far they are,
Mhm.
but there's another company too. I'm not sure if it's Walmart, but they are notifying employees that this potentially could be coming.
Hmm.
And so let's look at, if the legislator goes super fast, when can this be implemented? So pie in the sky, if everything goes fast, it could be implemented this year by November, December, which means that in that case, if it got implemented in November, December, Gavin Newsom signs it, that it becomes law, what they're going to say is retroactively, if you had the policy before November 2024, you're exempt. If you get a policy from December on 2024, I'm sorry, you're not exempt. You're going to have to pay the tax. So to get out, you actually have to actually goes backwards. You can't do anything going forward.
Okay, so we should be all watching the legislature to see what happens.
Yeah. I mean, it's in Sacramento right now. They're trying to find a sponsor to kind of push it through.
Mhm.
But they've met for over 2 years, so extensive meetings they've had.
Okay, and so it could be as soon as this November. That's if it goes through quickly. Obviously, there's a lot of other stuff that has to happen during that time period. So maybe
Yeah,
there's a little more time, but
probably
sounds
20,
like
maybe 2026
okay.
January, maybe. Um,
But it
That's
seems
what
like
we're
it
kind of
might be
speculating.
good to look into it anyway, early,
I
right?
yeah, I think it's good just to know, know what your options are. You
Hmm.
don't want to wait until the latter part because um, when you apply for long-term care insurance, it could take up to 3 months to get approved. So the lead time is actually pretty long
Okay,
from
that's
application
good to
to
know.
acceptance.
Hmm.
So if you wait, if you only do it at like a month before the deadline, there's no way you're not going to make it. Okay, so these are some of my top questions for my clients. So one is, would I qualify for long-term care insurance? I've had health issues in the past. Maybe I've had cancer, or I have, current health issues. I'm diabetic, or I'm undergoing PT, or I'm on the older side. So not all companies have the same criteria. So some are more strict than others, but it's really important to match the client and their health situation and their age with the right company. Um, what you don't want to do is um, apply to just say company X and then you get declined, because what happens is if you get declined, then it hampers your ability to get long-term care in the future. So you might have to wait a year up to 6 months. So some things we see with clients are physical therapy. Oh, I was playing pickleball and I hurt my elbow. I'm undergoing physical therapy. To us, that might not be a big deal. For the insurance companies, that is a big deal. So
Mm.
they could make you wait 6 months to a year. So
Okay.
really, selecting the company is super important, and that's where the agent comes in. Um, so next is, how do I know the insurance company is financially stable? Some banks going under, people are like,
Hmm.
oh, I don't know if they're going to be stable.
Right.
So there are four companies that help rate the insurance companies. So AM Best, Moody's, Standard and Poor, and Demotech. So each insurance company, they have insurance ratings. So just like school, there's A, B, C, and then plus and minus. Of course, the A's are better than the C's.
Hmm.
And what it tells you is, it says that if there's Armageddon and everyone files a claim, does the company have enough assets and resources to pay everyone out? So that kind of gives you the strength of the company and whether financially they can withstand something so big.
So, what you do, because you're not working for an insurance company, is you would be guiding clients through, how and when to apply and which companies to apply to. Is that part of what you do, or is
Oh
that
yeah,
what you do? Yep.
yeah, perfect. Yeah, thanks, Gene. Yeah, basically we're independent agents, and so we have a number of companies we could choose from. So if someone says, well, they're older or they have cancer, I'm gonna look at company C or D versus
Got it.
A and B.
Mhm.
And what we do is we actually contact the underwriters. We'll, and anonymously we'll say, oh, client X has this. Well, what do
Mhm.
you think?
Mhm.
And so we do that for a number of clients. And when clients do apply, if they have something, so let's talk about the pickleball tennis elbow thing.
Mhm.
We write a letter on behalf of our clients to kind of explain away, what was this, a short injury? They don't have any long-term things, because sometimes
Got it.
when you look at medical records, um, they make determinations that um, you that we need to explain away. So a couple other questions is, am I still covered if I move to another state or a different country? State. So California, if you move to Hawaii, you're still covered. If you move to a different country, then your policy, the benefits or the duration of how much you're paid or how long you'll be paid could be shortened. And the other thing is, can insurance rates go up? With traditional rates have stabilized, but they can go up. And hybrids, depending on the carrier, there are more premium guarantees. So generally, those don't go up.
How about so when going back to the states, though, if you're doing a state mandated LT long-term care, so say Washington State, if somebody pays into it, but then they move, or if California incorporates one and people pay into it, the
Mhm.
full 10 years and then move, are they still covered or they're no longer covered because they're not a resident of California?
Oh, good question. So Washington has now allowed portability. So
Okay.
before they wouldn't allow them to go state to state.
Mhm.
It just passed a couple months ago.
Oh,
So
good.
California is probably going to allow the same thing. California might allow international coverage, but it's hard to say because I think it's hard to regulate then,
Sure.
if you're just sending money out of the country.
Right, right. But at least within this United States, it would be great if there's some option because you may have people who in their old, as they go along, they decide, oh, I need to move out of state to be closer to my children who are not in
Mhm.
California. Then, but they've been paying all along. So that sounds fair. I mean, I know that it's not fully finalized yet, but just something to wonder about. So,
Yeah, so still working on it. I mean, during the meetings, that was a big discussion about basically called portability.
portability. Got it.
Yeah.
Thank you.
Uh-huh. So finally, so I get this question a lot. So my advisor says, I have enough money to self-insure. Should I pay out of pocket for long-term care or get insurance? And it's everyone's. It's up to everyone individually. But speaking from experience, I know self-insuring is like low leverage and
Mhm.
liquidity is based on timing, on the stock market or the real estate market and taxable. Insurance is, you get leverage liquidity because you don't have to worry about timing and the benefits are tax free. So when you receive those monthly benefits, it's tax tax free
Text.
there.
Mhm.
Yeah. And basically, in this example, I just wanted to show that if in this one you're self-funding, so you would put $300,000 away
Mhm.
for long-term care, or you could use $3,600 to give you the exact same amount of leverage.
Thank you so much, Michael, for the information. It's really important. And the LTCR Pacific, I'll put your information. Great. I was going to say, if you can put
Yeah.
up your information, that would be awesome. So that if people have any questions, they can reach out to you. And hopefully, people will start to reach out to you sooner than later, especially in California, if they're thinking about this program and possibility of not being able to opt out of that tax. If you're going to be paying the
Yeah.
tax anyway, why not get a better coverage for yourself and even have that hybrid option? Because it looks like, I guess I'm assuming California that mandatory program would not include the life insurance portion, right? It would be just a
No,
traditional long-term care
traditional.
insurance. So
Yeah.
to be able to have that hybrid option as well, and also to get more for your money, I think is great to know. So thank you very
Mhm.
much. Did you want to add anything to that, or to in closing?
I think that one thing is that some people are afraid to talk to us because they have a health issue or they're advanced age, and really, we're always a resource. There's no question that we can't help you with, or we'll find answers. So don't be afraid because we talk to a lot of people that are seniors, and they're like, oh, time has passed me by, but you know, just give us a call and or send me an email, and
Mhm.
then we can help you.
That's really encouraging to know because I think that's probably one of the biggest factors is we don't think about it until later, and then later you feel like maybe it's too late to think about
Mhm.
something like long-term care insurance. So people who are watching, you do have Michael's information on the screen, and I'm really excited to have found him as a resource, and he'll be joining us in August as well, right, for the seminar
Yeah.
then. So
Mhm.
we'll be looking forward to meeting you in person then and hearing from you at that time. Thank you.
Okay. Thanks, Gene.
So that's it. Be sure to contact Michael if you'd like to look into your options for long-term care insurance. It sounds like California is going to act something within the next year or two with regard to long-term care insurance. So it might be better to look into it before you're locked into paying the tax without the option of opting out into a plan that might be better for you, such as a hybrid option. Thanks again for watching, and be sure to let us know if there are other topics you'd like us to cover. Have an abundant and joyful weekend ahead.